What if you could beat the casino using nothing but math? What if you could build a fortune on Wall Street not through luck, but through logic, discipline, and numbers? This isn't fiction. This is the true story of Edward O. Thorp, a math prodigy, who used probability and statistical thinking to outsmart both Las Vegas and the financial markets. From secretly counting cards at blackjack tables to running one of the most successful hedge funds ever created, Thorp proved that a sharp mind and a solid strategy can crack even the most rigid systems. In today's video, we'll dive into the extraordinary journey told in the book, A Man for All Markets. It's a story that will not only inspire you, but may forever change how you think about money, risk, and success. While listening, if you like it and want to learn more, we have attached a link to buy the book in the description. Let's get started. The book A Man for All Markets 2017 tells the extraordinary life story of Edward O. Thorp, a mathematical prodigy who used statistical reasoning to beat casinos and revolutionized investing on Wall Street. The book explores how Thorp applied sharp, analytical thinking and a disciplined approach to risk management to consistently gain the upper hand both in gambling and in finance. Edward O. Thorp is a mathematics professor, hedge fund manager, and pioneer in the field of quantitative finance. He is best known for inventing the card-counting technique in blackjack and for founding Princeton Newport Partners, one of the first successful market-neutral hedge funds. Thorp is also the author of two classic bestsellers, Beat the Dealer, which mathematically proved that blackjack could be beaten, and Beat the Market, which introduced early concepts of arbitrage and securities trading. Most people believe the odds are stacked against them, whether at the casino or on Wall Street. But Edward O. Thorp thought differently. A mathematician with insatiable curiosity, Thorp saw games of chance and financial markets not as random mysteries, but as systems that could be analyzed, tested, and ultimately conquered. He wasn't interested in luck or speculation. What fascinated him was what could be proven and what edge could be gained through statistical reasoning, disciplined risk management, and rational decision-making. Thorp didn't come from wealth or privilege. He built his life on ideas, not on credentials. And he followed a path that took abstract equations and turned them into real-world results. Along the way, he invented card counting, helped create the world's first wearable computer, and launched a low-profile hedge fund that outperformed most of its peers, not through flashy predictions, but with cold logic and data. Through this story, you'll discover how Thorp used mathematics to beat blackjack, exploited inefficiencies in financial markets, and managed his personal wealth with the same calm and reasoned mindset that fueled his success. And it all started with a curious little boy, a Sears catalog, and a determination to figure out what a million really means. At just 5 years old, Edward Thorp decided to count to 1 million. He chose a Sears catalog packed with images and product codes as his tool, treating each circled letter next to an item as one count. Thorp grew up during the Great Depression in a struggling family, living off his father's modest earnings as a bank security guard. He lacked access to elite education, but he possessed something more valuable, a relentlessly curious mind and a habit of testing everything for himself. By age 3, he was conducting his own experiments with hot stoves and fragile eggs. At 5, he was calculating square roots and flipping through catalogs to practice arithmetic. Once, after overhearing a store clerk miscalculate a bill, young Thorp corrected the total mentally and earned an ice cream cone for his effort. He also taught himself to read at a very high level early on, becoming engrossed in books like Gulliver's Travels and A Child's History of England. This led to an unexpected test. Being asked to name every English king and their dynasty on the spot a task, he performed flawlessly. While his memory was impressive, what truly set him apart was his ability to spot systems, patterns, and structures in the world around him. And when something didn't make sense, he investigated it himself. Thorp wasn't driven by competition or praise. He simply wanted to understand how things worked. That innate curiosity became his greatest asset. What started with catalogs, numbers, Puzzles would eventually evolve into calculated strategies for taking on games of chance and winning. In 1961, Edward Thorp walked into a Reno casino and quietly beat the game of blackjack using a system he had thoroughly tested in a university lab. What the casino dealers didn't realize was that each of Thorp's wagers had been simulated thousands of times on an IBM 704 computer. While casinos believed blackjack was unbeatable, Thorp used mathematics to prove otherwise with absolute certainty. It began when Thorp analyzed blackjack as a mathematical system. Unlike roulette or craps, blackjack had memory. The odds shifted based on which cards had already been played. This meant players could track those changes and adjust their bets accordingly. Thorp developed a card-counting system that allowed players to do exactly that, giving them a statistical edge over the house. Initially, even his fellow mathematicians were skeptical. So Thorp wrote a blackjack simulator in Fortran and ran millions of hands to test different strategies. The data was clear, his method worked. To verify it in the real world, Thorp headed to casinos in Nevada with a modest bankroll, often disguising himself and varying his bet sizes based on his count. When he started winning consistently, the casinos took notice. Some reshuffled decks early to disrupt his strategy. Others simply asked him to leave. But once the method became public, card counters began appearing at tables across the country, much to the chagrin of casino operators. Though blackjack brought Thorp fame, he didn't stop there. He partnered with Claude Shannon, the legendary father of information, his theory to build one of the world's first wearable computers. The device could predict where a roulette ball would land, offering a significant advantage, though it proved difficult to use discreetly in real-life conditions. What made all this possible was Thorp's commitment to testing ideas against reality and his meticulous approach to managing risk. That same logical, disciplined mindset would soon be applied to a much bigger game than blackjack, the financial markets. When Thorp began analyzing the stock market, he recognized something familiar. The pricing of warrants contracts that allow the purchase of stock at a fixed price showed patterns that reminded him of blackjack. It's just like cards on a table. The numbers weren't truly random if you knew what to look for. He realized that the same statistical reasoning that had given him an edge at the casino could also be used to identify mispriced assets in the financial markets. At the time, most investors relied on instinct, reputation, or vague economic theories. Thorp chose a different path. He built mathematical models to price securities, tested them against historical data, and calculated the probabilities of various outcomes. One of his first targets was the price discrepancy between convertible securities and the common stock of a company. By carefully constructing a hedged position, buying one and shorting the other, he could earn profits with minimal risk. Regardless of the market's direction, Thorp's early success in applying probability theory to finance began to draw attention from professionals, including a bridge game that led to a meeting with Warren Buffett. Although they didn't end up collaborating, conversation confirmed for Thorp that disciplined, rational strategies had a place in investing. Soon after, he partnered with Jay Regan, a businessman with Wall Street connections, to begin managing money more formally. Together, they launched Convertible Hedge Associates in 1969, which later evolved into Princeton Newport Partners. The methods were fundamentally similar to blackjack. Find a quantifiable edge, manage downside risk, and scale up carefully. But the stakes were higher, and the environment more complex. Finance didn't have the predictable rules of a casino, but it had exploitable inefficiencies. Sando's weaknesses could be measured, modeled, and leveraged. With the groundwork laid for a new kind of investing, Thorp was ready to build something bigger. In the early 1970s, Edward Thorp was quietly managing a hedge fund that barely registered in the financial press. Yet its performance consistently outpaced the broader market with far less risk. The firm Princeton Newport Partners was built on a systematic approach rooted entirely in mathematics, not market forecasts. Thorp didn't chase trends or bet on companies. He focused purely on identifying pricing errors in complex securities and profiting from them using statistical models. What made the fund unique was its careful hedging. Thorp's team searched for opportunities where one security was mispriced relative to another, often involving convertible bonds. options, or warrants. Then, they set up offsetting trades to neutralize most of the overall market risk. Their profits didn't come from guessing where prices would go, but from exploiting the gap between financial theory and actual market behavior. Every strategy was back-tested. Every expected return was weighed against potential worst-case losses, and strict position sizing rules were followed. As the fund grew, it attracted more attention and more capital. But with growth came complexity. Regulatory scrutiny increased, and although Thorp consistently upheld high ethical and legal standards, one of his business partners became entangled in an unrelated criminal investigation. Though Thorp himself was never accused of wrongdoing, the association became a burden. In the late 1980s, he decided to shut the firm down, walking away from an exceptionally successful business. Despite its quiet end, the legacy endured. Princeton Newport proved that markets could be approached like a mathematical problem with strategy, discipline, and a measurable edge. The experience deepened Thorp's understanding of how markets behave under pressure and sharpened his ability to spot hidden risks. That insight would shape his thinking about money and uncertainty for years to come. By the late 1980s, Thorp had made a considerable profit by noticing something most investors missed. As fear spread through the banking sector, he realized that bank stocks had been excessively sold off relative to their fundamentals. He began buying aggressively, and when the panic subsided, the rebound was swift, resulting in substantial profits. This trade perfectly reflected his preferred style: assess the odds, plan for potential losses, and make decisions grounded in reason, not emotion. After closing his hedge fund, Thorp continued to manage his personal wealth, regularly identifying mispriced opportunities during periods of market stress. But during this phase, he also became increasingly aware of how easily investors could be misled by market volatility, flawed models, or even intentional fraud. He encountered schemes that promised steady, outsized returns, often masked by complex language and endorsed by respected names. Most of them, he saw, were simply illogical. He stayed away, but he paid close attention to how these deceptions operated. He also recognized that many investors fail not because they lack information, but because they misunderstand risk. One of Thorp's core beliefs was that long-term survival is more important than short-term gain. He applied the same logic he had used in blackjack and derivatives pricing: measure your edge, estimate downside risk, and never bet more than you can afford to lose. He watched others ignore these principles and often suffer the consequences. Even with his strong mathematical foundation, Thorp never assumed he had all the answers. He had learned how to spot systemic vulnerabilities such as excessive reliance on leverage or blind faith in market stability that could unravel even the best strategies. His focus gradually shifted from maximizing returns to identifying the hidden dangers and assumptions people took for granted. What followed was a series of practical insights from Thorp on how to grow and protect wealth without relying on forecasts or financial gurus. When asked how much money a person truly needs, Edward Thorp always starts with a calculation. His thinking always begins with probability. And he approaches personal finance the same way he approaches blackjack or hedge fund strategy: focus on numbers, odds, and the power of compound returns over time. Instead of chasing high returns, Thorp emphasizes avoiding losses and letting compound interest do its work. He explains that growing wealth steadily over time is more effective than trying to double it quickly while taking on excessive risk. He often cites the Kelly criterion, a formula originally developed for optimizing telecom signals to determine how much to bet or invest when you have an edge. Bet too little, and your strategy is inefficient. Bet too much, and you risk losing everything. It's a delicate balance, and one he follows strictly. Thorp was also an early advocate for index funds long before they became popular. His analysis showed that most actively managed funds underperform the broad market, even those run by so-called experts. For the average person, he argued, investing in broad market index funds and minimizing costs yields better results than relying on stock pickers or trying to time the market. He saw this as a natural extension of what had always worked for him: seek advantage, stay disciplined, and avoid emotional decision-making. He applied this mindset to every aspect of financial planning, from asset allocation to timing and risk acceptance. to defining what enough really means. To Thorp, money is a tool that can be grown and protected with logic and patience. His approach, though simple in appearance, rests on complex mathematical foundations designed to work in an uncertain world. With his own finances secured, he turned his attention to how this way of thinking could help others and what responsibilities come with that freedom. Eventually, Thorp stopped managing money for others. This decision gave him the freedom to reflect, to give quietly, and to maintain his independence, something he valued more than headlines or billion-dollar funds. After decades of using mathematics to gain an edge in games, markets, and systems, his greatest interest became how similar ideas could improve people's lives. He believed the rational principles that helped him build wealth could also guide how one uses that wealth wisely. Thorp contributed to causes aligned with his values: science education, rational decision-making, and organizations that use data to measure real-world impact. He supported university programs and independent researchers, always preferring private action over public recognition. His goal was to make a difference where outcomes could be observed, not to spend for prestige or applause. Looking back, he also reflected critically on how financial systems had evolved. He saw recurring patterns of overconfidence, poor risk management, and crises that punished everyday people more than the institutions responsible. What frustrated him most was that many of these failures could have been prevented with basic statistical thinking. Thorp believed that better financial and mathematical education for the general public could help prevent future harm. His final reflections remained true to the logic that had guided him his whole life. Avoid excessive risk. Keep learning. Question assumptions, and understand that small, consistent edges accumulate into great outcomes. He never claimed to have perfect foresight, but he trusted in his method, using the best available information, crunching the numbers, and acting accordingly. That mindset had carried him through every challenge and delivered a life of clarity and contentment. To Thorp, success wasn't defined by the amount of money he made, but by how well he understood risk and how wisely he chose to use the results of that understanding. The core message of this book is that clear thinking, grounded in mathematics and logic, combined with disciplined execution, can uncover opportunities others write off as mere chance. Thorp proved that you don't need inside information or flashy predictions to succeed. You need patience, logic, and the courage to trust what the numbers are telling you. Whether it's card counting, pricing securities, or managing personal wealth, he applied the same careful thinking. Measure your odds, cap your downside, and stay consistent. His life is a powerful reminder that with the right tools and mindset, we can think independently, avoid costly mistakes, and build a future on our own terms. Reading A Man for All Markets was both enlightening and inspiring. Edward Thorp's life story is a masterclass in how rational thinking, mathematical precision, and intellectual curiosity can transcend boundaries, whether in gambling halls or on Wall Street. What impressed me most was Thorp's consistent approach to life. View every challenge as a system that can be understood, tested, and optimized. His journey from blackjack tables to hedge fund dominance wasn't driven by luck, but by discipline, experimentation, and a deep understanding of risk and probability. It's remarkable how he applied the same core principles, finding a quantifiable edge, managing downside, and staying patient across such different arenas. His use of mathematics, not just as a theoretical framework, but as a real-world tool, reminds us that logic is a superpower. Thorp didn't gamble, he calculated. And perhaps most admirable is his ethical stance, never cutting corners, even when opportunities for easy gain presented themselves. He chose integrity and independence over fame or reckless fortune. Beyond finance, this book serves as a broader lesson in how to think critically and act with reason in a world full of noise, hype, and irrational behavior. For anyone looking to sharpen their thinking, avoid costly mistakes, and live a principled life, Thorp's story is a beacon. But that wraps up our deep dive into this remarkable book. I hope it's been valuable to you. If you're interested in more titles with similar themes, leave a comment with your thoughts and recommendations. You can also buy the book to experience it more clearly, as well as support the author. I will leave the link in the description below for you to easily search If you like the channel, you can press the like button, share, and turn on the notification bell to receive new content. Thank you so much, and we'll see you in the next video.